Good morning, everyone. I'm Micah Stewart, a director in LaPorte's tax group, and I will be moderating today's webinar. We're happy that you could join us today and hope that we can help clear up some of the muddied waters as they relate to the COVID relief for businesses. Over the last year, we've seen several rounds of legislation related to COVID relief and have been inundated with guidance from the SBA and IRS related to that legislative relief. Today, we'll be focusing on the Consolidated Appropriations Act, which was passed in late December and included in part revisions to the Paycheck Protection Program and the Employee Retention Credit. As a matter of housekeeping, we would like to note that all attendees are muted, video is turned off, and that the chat feature has been disabled. Questions can be submitted via the Q&A portal, and we will try to answer all questions at the close of the presentation. We're recording this session and we'll be sending it out within 2 to 3 days to anyone who registered. We wanted to alert you to the fact that it was being recorded in case it affects your participation in the Q&A at the end. Today's presenters are Jack Wiles and Stephen Sisak, both CPAs. Jack is a senior manager in our tax group and has been with the firm for 12 years. Jack serves a wide variety of entities, including small, closely held companies, S corporations, partnerships, limited liability companies, and multi-state entities. He helps clients through the many stages of their business cycles, including advising on entity selection, converting C corporations to S corporations, and changes in ownership. Stephen is a director in our accounting services group. His principal client focuses on closely held and family-owned businesses. He has performed compilations and reviews of financial statements, provided small business consulting, and assisted with mergers, sales, and acquisitions. Stephen is a member of LaPorte's SBA task force and has assisted in PPP loan application and forgiveness calculations for clients. And with that, I'm going to hand it over to Jack.
Thank you, Micah, for that wonderful introduction. Steve and I are super excited to talk to everyone on the call about the Consolidated Appropriations Act of 2021. There is a lot of information that we're going to cover, so we're going to try to keep everything as simple and easy to follow as possible. We know a lot of you have PPP loans, employee retention credits, all these issues are top of your mind right now. You're either trying to apply for forgiveness, you may be part of that group that's applying for their first PPP loan. Maybe you're thinking, okay, I need to apply for my second PPP loan, or maybe you're going through your audit, your financial statements right now, you're closing out the year. How do I treat these for tax purposes? What are the ramifications? There's a lot going on right now. It's a busy time of the year for anyone normally, but with all this other information hanging over our heads, we're going to try to give you some good information to help you get through the rest of the year. So just a quick outline of what we're going to cover today. First in the agenda, I'm going to go over kind of a recap of the PPP loan timeline, what that entails, what you should be providing, what is covered by the PPP loan. Then we're going to go over some of the PPP tax considerations. How is that PPP loan forgiveness treated for tax, those expenses? And then we're going to have one slide that's going to kind of cover some of the other tax parts of that latest legislation that was enacted. Then I'm going to pass the baton over to Stephen, and he's going to take a deeper dive into the employee retention credit, go over those issues, what you need to know about that. And then we're going to leave plenty of time at the end for questions and answers. I know a lot of folks are scratching their heads on this topic, so feel free, like Micah said, go ahead and click on that Q&A portal, send us a question. We'll do our best to answer those. We know some of those questions might be a little personal in nature. You don't want to maybe announce them to the whole group, or maybe when you're digesting this, when you're thinking about it later, when you're looking over the slides or talking about it with some of the other owners, business leaders, or your finance unit, something may pop in your mind. So Stephen and I have included our email in the very end of this presentation. Feel free to reach out to us. If we can't get you an answer right away, we have folks here who can hop on that and get you an answer that you need. So without any further ado, let's go ahead and hop into the presentation. So let's kind of take a step back and discuss big picture. What does the PPP loan process look like from a time standpoint? I know there's a lot of dates that are thrown around, 8 to 24 weeks, 10 months, 10 days, 60 days, 90 days, 30 days. What does all this mean when you're talking about the big picture? We designed this slide as kind of a quick reference for you. I would envision y'all going back, thinking about the process, whether it's the first time you're applying for a loan or you're somewhere in the middle of that process and you just constantly are going to Google, how long until this wraps up? Rip this page out, stamp it on your own copy of your application, staple it to your calendar so you can have a better idea of the timelines you're looking at. So the newest legislation, the latest guidance allows for 8 to 24 weeks for you to spend those funds, right? Now, once that covered period ends, You then have 10 months to file your application for forgiveness. So for example, let's just say you picked 8 weeks for your covered period. The moment that 8 weeks is up, the clock starts on your 10 months to file your application. You then have 60 days for the bank to review and approve the forgiveness application. There might be a little back and forth. Hey, what'd you mean by this? Could you show us more backup here? Hey, we're not understanding this part. So they gave the banks, roughly 2 months in order to kind of get everything squared away. Then after the bank submits everything to the SBA, you have 90 days, or the SBA has 90 days to approve forgiveness of that loan. Once that decision is rendered to you, if you don't like what they said, you then have 30 days to appeal. All right. I mentioned that 10-day period. What's that? For loans of $2 million or more, so those larger loans out there, an SBA form 3509 is required. And this is just called the necessity questionnaire. So once you receive this, you have 10 days to reply back to the SBA. Essentially what the SBA wants with this additional form, I know you're tired of filling out forms, but if there's this much money, they do ask for one more form. They want to get some sort of attestation that you made a good faith judgment that there was an economic need for this loan. So this is their official form that they use. It helps them streamline the process. Remember, you may just be doing one or a few of these, but they're processing millions. So they're trying to make it as quick as possible. Then it is important to remember that once this is all said and done, that doesn't end the timeline. There is a 5-year statute of limitations for the SBA to go back and then question any of the loans at any point in the process. So just like an IRS audit, there's a couple of years for the statute of limitations. The SBA also has one of those just in case they need to go back. So that kind of summarizes timelines. Again, this is a nice quick reference guide for you to add to your files. Okay, so let's talk PPP deductibility. One of the big issues that came out was there was a lot of uncertainty on the taxability of the PPP loan funds. If this debt is forgiven, if this loan's forgiven, will this be subject to taxable income? There's this concept of cancellation of debt income that kept coming up. Will the loans, if forgiven, be subject to tax? And if this loan is forgiven, am I allowed to deduct the expenses? Originally, there came out with IRS Notice 2020 saying, look, we can't allow, if the debt's forgiven, it's not picked up in income, which was allowed, we're not letting you deduct the expenses. And as you can imagine, I'm sure everyone on this call was part of this, there was just a massive uproar. People were not happy about this. Both the business community were saying this doesn't seem really fair. And then the lawmakers that wrote everything said, this wasn't our intent. We are so sorry, but we wanted it to be deductible. Well, the IRS said, we're kind of handcuffed here. We can only rely on tax law. And the current tax law states that these expenses shouldn't be deducted. They then issued Revenue Ruling 2020-27, which kind of gave guidance to taxpayers who had submitted for a loan forgiveness, but hadn't yet received any word from the SBA on whether or not that loan would indeed be forgiven. The IRS stated, look, if you have a reasonable expectation that your loan is going to be forgiven, you can't deduct those expenses right now. So what they said a reasonable expectation was that if you did everything you were supposed to do in order to get that loan forgiven, that's good enough to have a reasonable expectation and those expenses couldn't be deducted. Again, everyone wrote their congressman, made phone calls, emails, there was lobbying done. AICPA wrote some strongly worded letters. No one was happy about this. The IRS said eventually, look, if you want us to allow this, you have to make a law change. We're handcuffed to the current tax law. Well, this is why it's important to call your local government officials when you're not happy with stuff and, make a stink about stuff if you don't think it's right. Because on December 27th, with the Economic Aid Act, the IRS made two very clear statements. They said the lawmakers passed a new set of laws that the IRS could follow. Sorry. They said, one, let us be clear that forgiven debt is not subject to income. And number two, the expenses that are made with those PPP funds are allowed to be deducted. So huge win, hence the fireworks on this slide. Everyone's happy. Not only we get the, double the bang for our buck, not only do we get tax-free cancellation of debt, we also are allowed to deduct these expenses. So a clear win for everyone. Pass-through entity owners also got some good news. The cancellation of that debt will be treated as tax-exempt income. You'll get an increase in basis. So another huge win for the business community. Where there is, however, some further discussion, analysis, and uncertainty is at the state tax level. As y'all all are aware, states don't have to follow federal treatment really for anything. They have their own tax laws, tax code that they enforce. Some states can just follow verbatim what the federal does. Some have carve-outs, that kind of thing. So if you are a business owner or a finance person within an entity that has multi-state activity, it is imperative that you sit down with your tax advisor and truly understand how each tax jurisdiction is going to treat these PPP loan funds and expenses. California, for example, has stated that the cancellation of debt, the forgiveness of the loan, that's not going to be income, but you're not allowed to deduct those expenses. Texas has not really weighed in on the issue a whole lot or issued real authoritative guidance. Louisiana has said, look, we're not going to treat it as income, but they really haven't weighed in on the expenses. And that's just 3 of the 50 states. So as you can see, if you have multi-state activities before you file your returns, it's imperative that you sit down and understand all the tax consequences for each state as a result of the PPP loan forgiveness and the deductibility of those expenses. In addition to that clarification with that latest Economic Aid Act that talked about the loan forgiveness and deductibility of expenses, they also added some additional costs that are allowed to be covered by the PPP loan funds. We're going to talk about those first 4 at the top here. Covered operation expenditures. So I'm going to read straight from the SBA guidance because I think it's extremely helpful. It's not too long, so bear with me here. What are covered operation expenditures? Some examples are any business software or cloud computing service that facilitates business operations, product or service delivery, or the processing, payment, or tracking of payroll expenses, human resources, sales and billing functions, or accounting or tracking of supplies, inventory, records, or expenses. So as you can see, that description in and of itself covers a wide variety of topics. If you're interested in having maybe some of these expenses covered by PPP loans, worth looking at the FAQs and understanding if maybe you do have some additional expenses that could be covered. There's also the second category, which is covered property damage costs. These are costs related to property damage and vandalism or looting due to public disturbances that occurred and were not covered by insurance or other compensation. There is still guidance that needed in this area to determine exactly what's a public disturbance, how high of the level. There's some gray area there. So this may be some expenses you would include as a last resort to be able to use all of your PPP funds, but it's out there and it's worth investigating if you think you have some expenses that would qualify. There's also covered supplier costs. These are any expenditure made by an entity to a supplier of goods that are essential to the operations of the entity and is made pursuant to a contract that was in effect during the covered period. Again, another category of expenses you now have an option to use under PPP funds. And then I think this is going to be the one that's going to apply to a lot of those businesses that are on the call that have storefronts and had to incur a lot of expenses to make those storefronts operational under CDC guidelines, are these covered worker protection expenditures. These are an operating or capital expenditure that are to facilitate the adaptation of the business activities of an entity to comply with requirements established or guidance issued by the CDC, OSHA, or other equivalent agency. All right, so examples of these. These may include purchases such as physical barriers like plexiglass. So if you think you walk into a drugstore or grocery store and they have all the plexiglass up so that their employees and the people that are there buying goods can feel safe and can, stop the spread, that's covered under this. Personal protection equipment, including face masks, on-site health screening capabilities, drive-up facilities, air purification, or ventilation systems. So if anyone can think of walking into a local grocery store, you've got all kinds of plexiglass up, barriers, maybe they added a new section out on the driveway or the parking lot, that you can drive up, restaurants, all kinds of different businesses had to incur all these costs to make it so their customers could come in and feel safe. That's now covered under some of these worker protection expenditures. So again, part of your PPP funds could be used for this, and it's worth taking a look to see if you have expenditures that could be covered. It's also good to point out that these were treated as if they are originally included in that original CARES Act that was passed, it feels like, a long time ago at this point, but these are retroactive. However, one caveat, these are not available for loans which were already forgiven before the enactment of the Economic Aid Act. So it's important to remember these costs are included in that bucket that are 40% of other costs of your PPP loans. We're going to say this a few times, but 60% of your funds had to be used on payroll and then 40% other. These would fall in that other category. So payroll costs, the top section, not much has changed from the original PPP loan guidance that came out: salaries, paid leave, healthcare payments, and retirement benefits. The new costs that are now under here are some of these group insurance costs. Examples are group life, disability, vision, and dental care. And these are effective as if they were included in the original CARES Act. So these are retroactive. So good to know. These you can lump into that 60% category, those other, that compensation part. Okay, so now we have the PPP first draw reopening. Who's allowed to do the first draw again? These are eligible entities that did not receive a PPP loan last year. It could be for a variety of reasons. Maybe you just didn't apply. Maybe you were an exempt, you were an eligible entity. Maybe you're a 501c6 organization that wasn't allowed to get a PPP loan under the CARES Act. You now are, if you have qualifying expenditures, you have the gross receipts test, you meet all these things, you can now apply for the first draw. It is also eligible for existing PPP borrowers that did not receive loan forgiveness and are eligible for an increase in their loan. Why would someone be eligible for an increase in their loan? So we'll look at a couple of examples. The first one, maybe you returned a portion of your PP or maybe all of your PPP loan funds. It wasn't completely uncommon for folks to hear their amount that they were eligible for, get a little nervous on the amount. Maybe we wouldn't be able to spend these. We don't want to take on that additional debt in these uncertain times, so we return a portion of it. Maybe we got nervous about that economic uncertainty clause that was thrown around a lot, so we just didn't accept it, or we only accepted a portion of it. If that's your case, maybe you would look into being able to go back for this first draw reopening. Those who did not accept the full amount of PPP funds that they were eligible for. What would that be? Maybe you're a partnership and you didn't include your partner's compensation. You were allowed up to $100,000 for those. So maybe you didn't include that for a wide variety of reasons. But how do I know if I didn't accept the full amount? Well, the SBA has actually been very good on their website with their FAQs and providing guidance. I think a lot of other governmental agencies could take some cues from them because they have their website, their FAQs are an amazing resource. So they went and issued this guidance, and we have it listed here, how to calculate the maximum loan amounts, first draw PPP loans, and what documentation to provide by business type. So this would have clarifications on, did I get everything I could if I'm a partnership? Did I get everything that I could if I am if I'm a sole proprietor? What if I'm just a seasonal business? What if I'm a nonprofit? They have all of this broken out by category, by business type. It's a great read, simple, well, great read, tax nerd, sorry. It's an easy read, common language, super helpful. So I recommend everyone go ahead and check that out. And then there was also new guidance issued for seasonal employers who may benefit from those new calculations that were implemented in this latest act that was passed. When you're doing that first draw, your borrowers are allowed to use either the 2019 or their 2020 payroll amounts to calculate the maximum loan amount. And then, important to note, the end game, this program ends on March 31st. Okay, second draw loans. Who is allowed to dip back into the pot again? Those that can do this are, you previously received a first draw PPP loan, and you will or have used the full amount of loan for authorized uses. So what does that mean? I got a loan, I spent everything the way I was supposed to, the SBA had no issues, but I still am running into some economic hardship and would like to dip back into the pot. An organization that has no more than 300 employees. This is a change from the first draw, where that limit was 500 employees. So it's kind of narrowing the scope of who can get that second draw PPP loan. And then an organization that can demonstrate at least a 25% reduction in gross receipts between comparable quarters in 19 and 20. You must use calendar year quarters. So your standard quarters you would think of in a calendar year, you can't just make up 3 months. And there is also a borrower that experiences at least a 25% annual decline in gross receipts from 2019 to 2020. So 2 options there. Go ahead and, if you think you can fall into this category, worth taking a look. Again, I want to reiterate this, that there are special rules for businesses that were not around for the entire calendar year of 2019. So if you're a newer business and you weren't around, you were only there for part of the year, the SBA did take this into account, but you do have to pass different requirements, different rules. So if that is your scenario, go ahead and look over those specific FAQs and talk to your tax advisor or us if you need any help on that. Okay. So we talked about, the revenue test. You have to show a 25% decline in your gross receipts. If you're a business owner or a part of a business group that has multiple entities, you may have to watch out for the affiliate rules. What that is you would have to aggregate different entities when applying for the PPP loans. Okay. Before I even start on this, the rules I'm about to discuss are just for PPP loans. There are different affiliate rules for the employee retention credit. So unfortunately, you're going to have to pay attention to me and Stephen when we talk about the affiliate rules, and make sure you follow the rules for PPP affiliation, for PPP, and same for ERC. So pay attention if you feel like you're going to be playing in both sandboxes here. Those rules are going to be different for both your employee count and for the gross receipts test. So how do I know if I have an affiliate group? Well, the first test is affiliation based on ownership. Pretty self-explanatory. Is there a person or a group that owns more than 50% of similar organizations, right? So that's not conceptually hard to understand, but there is another part in there. You could have a minority shareholder in two different business entities, but the governmental documents for those entities gives that shareholder blocking power, veto power, or certain powers where the SBA would be able to come in and say, well, look, that person really does have control over multiple entities. So for our purposes, we're going to treat that as an affiliate. So if you have that kind of minority shareholder who wields a lot of power for a minority shareholder, go ahead and refer to those rules. The next rule is not going to be as common, but if you have any stock options, convertible securities, or other agreements to merge with other entities, make sure that you see if those would subject you to these affiliate rules. The third one, affiliation based on management. So think of this as we have multiple entities with overlapping bigwigs. We have a CEO who oversees several entities, or the exact same board oversees several entities. So that top tier level employee, are they overseeing multiple entities? And then affiliation based on identity of interest. So this one's a little different. So I'm going to read this one. In this case, affiliation arises when there is an identity of interest between close relatives with identical or substantially identical business or economic interests, such as where the close relatives operate concerns in the same or similar industry in the same geographic area. So for this case, let's say you got two brothers or two sisters. They both own construction companies in the southern Louisiana area, for example. You may want to look into this affiliation based on identity of interest and see if you need to use those rules when applying for PPP funds. Okay, we've talked about one of the tests to be able to get the PP funds is that reduction, that 25% reduction in gross receipts for the comparable periods. So how is the SBA defining gross receipts? Well, gross receipts generally are any revenue in whatever form received or accrued. So think of that we look to our financial statements accounting treatment. For the cash method, the cash that comes in the door. If we're accrual, we would look to our normal rules for accruing revenue, okay, from whatever source. So if I'm an attorney, my fees that I'm generating, construction, the fees I'm generating from construction. If I'm a consultant or any kind of like a real estate agent, my fees that I pay, or if I'm selling goods, cupcakes, anything like that, the fees I get from that. And then it also includes investment income. So any interest, dividends, rents, royalties, anything like that, except you do not include net capital gains and losses. So most investment income, not all. Also important to point out is you are supposed to reduce the gross receipts by any normal returns and allowances that you would have under your accounting method. If you're a for-profit business, we'll talk about nonprofits in a second. So when you're doing this application, filling out the gross receipts part, it's important to note that the 2020 gross receipts do not include any amount of loan forgiveness on the first draw PPP loan or any EIDL grants. So do not include those proceeds. I mentioned that nonprofits have a different standard. They include all items of income, but they don't include the expenses that the for-profit would. The easiest example I can think of is fundraising events. So if you're throwing a fundraiser, if you can think of, for the nonprofits on the call, if you can think of on your Form 990, on page 9, you would show gross fundraising income, and then you would show all related expenses right below that would come to a net number. You don't include those in your PPP application, the expenses portion. You would just show that income portion. So important to know what rules you need to follow for gross receipts, depending on your type of business. Okay. Second draw loans. The SBA issued guidance in January outlining the rules, how to calculate your revenue reduction, how to show your maximum, or how to calculate your maximum loan amounts, and what documentation you need to provide to show this reduction in revenue. So what are the documentation requirements to support your 25% reduction? Some things that they have said they will accept are quarterly financial statements, quarterly or monthly bank statements, or if you're going with that annual report, the 19 and 20 tax returns for your entity. A lot of companies have not filed a 2020 tax return. It's late February, so if you've already filed your business return, kudos to you, but not a lot of folks have already. So if that's the case and you haven't filed your 2020 return, you need to fill out the revenue section and the appropriate sections as if you had, sign the return, and then attest that these will be the numbers that will be reported on your eventually filed tax return. When do I have to supply this backup documentation? Well, if your loan amount is greater than $150,000, you supply all your backup documentation when you submit that application. So I would like a loan, here is my backup. If you are asking for $150,000 or less, you supply this backup documentation when you're asking for forgiveness. So at the end, if that is the case, you're one of the folks who are asking for the smaller amount of the loans and you have a longer period of time to submit that, we still highly recommend that you gather this information on the front end, work with your CPA and your banker to make sure you have all your ducks in a row. So that way, when you go to apply, you don't have to recreate everything in a scramble. It's always best to work beforehand, make sure you've got everything covered, right? When it comes to second draw loans, every business may only apply for one second draw PPP loan. There's not going to be a double dip in the second draw, unfortunately. I'd like to point out that if an entity has permanently closed, it is ineligible to ask for a second draw PPP loan. And this application period will be open until March 31st, 2021. Okay, the maximum loan amount is 2.5 times the average monthly 2019 or 2020 payroll cost, up to $2 million. Any borrower who's applying for these PPP loans in the accommodation and food services sector, that amount is 3.5 times the average payroll. So if you're in that particular section and they mention the NAICS codes that you need to fall under in order to apply for that, you do have a 3.5 time average up to $2 million. If there is a commonly owned corporate group, it's a $4 million maximum, and that's through common ownership, right? And then there is no additional payroll documentation required to be submitted for a second draw PPP loan application if the borrower is using the same lender and the same payroll time frame as it used in the first draw PPP loan. So it's kind of a narrower group of applicants who would do that. But if those two items line up perfectly, you would not have to resubmit your original payroll backup, okay? So what payroll reports do you need in order to substantiate the payroll that you're using your calculations for? Think of payroll reports from your payroll provider. A lot of these businesses are coming up with special reports to help you with the PPP process. So if you have a provider that you use for payroll, talk to them and see if they can help generate one of these reports. Your forms 941, your payroll reports, any official documentation that you would have that shows you made any contributions to retirement or those health insurance items. And then any official documentation that you can verify you made the appropriate interest payments, rent, and utilities. So if you have statements showing that you paid them, canceled checks, that kind of stuff, keep that in your file and show that as backup documentation for qualifying expenses. Be smart and try to present the easiest to follow documentation. Make the paper trail so that any fool could follow it, because that is just going to streamline your process. It'll eliminate that ping pong back and forth between you and the banker and that front end, and will help the SBA easily process everything. You don't want to make it and just a painstaking process if it's something you can prevent. So we're going to reiterate what kind of expenses qualify for second draw PPP loans. There's the payroll costs. Those are going to comprise 60% of your total costs from the PPP funds. Mortgage interest, rent, utilities, and then those 4 new categories: your operation expenditures, your property damage, your supplier costs, and your worker protection expenditures. Just remember, 60% has to be payroll. So Stephen's going to talk about this a little bit more, but if you're looking to play in both sandboxes again with the PPP and also the employee retention credit, it may be worth trying to keep that payroll cost as close to that 60% marker as you possibly can, so that you get a bigger bang for your buck when you're going for the employer retention credits. You can't use the same payroll costs for both. So you got to kind of do an analysis and see what works best. This is just a quick list of who cannot apply. If you fall into any of these categories, unfortunately, you cannot get a second draw PPP loan. So if you think you're one of these, talk to your advisors and see if there's any way that you can, just make for certain that you can't apply for the second draw. All right, quick little summary here. Reminder that covered period for your expenses can be anywhere from 8 to 24 weeks. You have to spend at least 60% of the forgiveness funds for payroll costs. You also have to make sure that your employee and your compensation levels are maintained at the appropriate levels, the SBA said. So make sure you're monitoring that throughout the covered period. The deadline to submit for forgiveness is 10 months after the end of the loan forgiveness covered period. So for our previous example, if 8 weeks is what you chose, right after that 8 weeks, boom, your 10-month period starts. If you're one of those large borrowers, 2 million, when you get that form 3509, you have a very quick turnaround time of 10 days. So get your ducks in a row beforehand. And one quick note to here, the Economic Act repealed the requirement that the EIDL advance amounts received be deducted from the PPP forgiveness payment. What if I'm one of those small borrowers that only got $150,000? Do I still have to jump through all these hoops? The answer is no. There's the small business carve out where you just have a 1-page signed attestation of compliance. So here's my 1 page. I promise you everything's good. You don't have to include calculations, fancy complex figures, any of that kind of stuff. You don't submit documentation. Some lenders, however, will want to see some things just because they got to make sure they're doing the right thing as well. If you do go this route, and just because you're not jumping through all the hoops as everyone else, it's super important to remember that it doesn't eliminate you from the pool that the SBA could audit you, right? So it could be a couple of years down the road, the SBA comes knocking on your business's door and says, hey, we just want to make sure you did everything you were supposed to do. Can you hand us your PPP packet showing all your documentation? Don't throw away your records immediately once everything is resolved. Put it in your permanent files, make sure you have access to everything, record your decision-making processes, how you documented everything, and then don't just forget about it. Make sure it's in a place you'll remember. So then a couple things I want to talk about. They did sneak in some tax stuff in addition to all the PPP guidance and employer retention credit. The restaurant industry was hammered hard. They had a great lobby. They really said we need help. So business meals at the moment are now 100% deductible, but they're only for food and beverage at restaurants. So they're kind of throwing the restaurant industry a bone here. Go ahead. They want to kind of stimulate some spending in that area. There's a limited amount of real property depreciation benefits here. If you're in a real property trade or business and you're trying to make certain elections, they did change the ADS depreciation life from 40 years to 30 years to recoup those costs. So if you're for real residential property, so if you're in that field, there may be some opportunities for you there. They did keep the above the line deduction for charitable giving. That's $300 if you file single, or $600 for married filing jointly. They also snuck in some extenders that they're trying to keep in to stimulate certain areas. That new markets tax credit, that's to promote investment in certain low income communities. Work opportunity tax credit, that's to spur hiring of certain types of workers. There's the employee credit for paid and family medical leave. This is different than the CARES Act credit, so make sure you understand the difference if you're interested in that. There's also exclusions for certain employer payments of student loans. And then finally, the carbon sequestration credit. I mess that up every time. This is if your business emits carbon dioxide. There is if you put certain safeguards in to collect some of that emissions, there could be the possibility that you get a credit for that. So if that is something you think you may be doing, this could be an area where you could receive some tax credits. Now, I'm sure you're tired of hearing of me and about the PPP. So I'm now going to pass the baton over to Stephen for him to talk about the employer retention credits.
Thank you, Jack. So what we'll be doing is talking about the retention credits. Let me pull up my screen, if you don't mind, and we can jump right into it. So the big thing that we need to consider about is the employer retention credit was created with the CARES Act, then it got adjusted. Then we have the Consolidated Appropriations Act. And now, how all this interplays, then you have the PPP loan considerations. So there's a lot of moving parts to this. So what I kind of want to do is kind of set the stage where we get some background information as it relates to the CARES Act. And then we'll just kind of work through the decision-making process as it goes along. So really quickly, the employer retention credit is a refundable tax credit eligible to employers that can get immediate access to the credit by reducing employment taxes deposits, mainly your non-41. If the credit is larger, you can even maybe get an advance payment and get your credits back. And so the idea was to kind of keep the cash in the companies as they were going through this questionable time of employment and retain their employees. So under the CARES Act, really simple. It was the cover periods between March 12, 2020 to the end of the year, 12/31. The credit is equal to 50% of up to $10,000 of qualified wages. And we'll talk a little bit more about qualified wages as we proceed in this presentation. The maximum credit, though, for the whole entire covered period is $5,000 per employee. The large employer, which this has an impact on qualified wages as well, is considered to be 100 plus full-time employees. And so, people are trying to be smaller employees, and we'll talk, as I said, a little bit more about that. Who's not eligible was the Paycheck Protection Plan participants. So this was as it was defined in the CARES Act. So what ended up happening is under the Consolidated Appropriations Act, the first thing they did was allow businesses that were participating in the PPP program to get them into the employee retention credit. So when they made it eligible, it was kind of important because, look, if you were in the PPP loan program, you weren't looking for those credits. And now here's a chance for you to go back and gain some credits possibly. You should really evaluate it. If you qualify for both, let's go out there and get those credits. And it could be sizable at $5,000 per employee. It doesn't take much to add up quickly. It also expanded the allowable size of a company. So there was a change to what a large employer was considered. Extended the program for the first and second quarter of 2021. It also increased the amount of maximum wages used for the credit, and it modified the definition of a significant revenue decline. So under the Consolidated Appropriations Act, the cover period was from 1/1/2021 to June 30th, 2021. The credit was increased from 50 to 70% of $10,000 of qualified wages. So the maximum credit is $7,000, but this is now a per quarter per employee, as opposed to the $5,000, which was for the full cover period under the CARES Act. Large employers are considered 500 plus full-time employees, and now all Paycheck Protection Program participants are eligible to participate for the employee retention credit. And so you can actually go retroactive, as I said, and look back into the 2020 and see if you qualified for those credits as well. This schedule is a nice little schedule that I use. I keep it handy. It's one of those tools that I would keep beside myself. March 12th to December 31st is the CARES Act. It goes through the cover period. Consolidation, as I said, is the first 2 quarters of 2021. It tells you about the monitor credit. Small employer qualifier, what are the terms? What are the number amounts? Gross receipts test. We'll talk a little bit more about this. But the CARES Act, it was a 50% decline in the 2020 versus 2019 quarter. So you have to schedule out all your quarters and look at your gross receipts and look at 2019, and you have to hit a 50% decrease to kick in to be eligible for the credit. It changed for the consolidation credit. It switched to a 20% decline. So a lot more businesses are going to be able to qualify. Then there's an election for an alternate period. Basically what they said was, instead of looking at back and forth between 2019 and 2020 and 21 and 2019, you can actually just look in the preceding quarter and see if you qualify. There's a decrease of 20%. So how does this all work? You know, the question is what you have to look at. So there's three things. There's eligibility, small versus large employee, and qualified wages. And these are the considerations that when I sit down and talk to clients, we kind of take step by step to determine if there is employee retention credits available. To help us facilitating these decisions, we have two decision-making trees included in here. One's for the 2021 quarters. Be careful, the other one's for the 2020 because they play by different rules. As you can see, basically you would start right there at the top, and it deals with the eligibility. You know, was there a suspension of business operations due to government interference? Was there, if no, is there a gross receipts decrease that we have to consider? On the side, on the left, you'll see FAQs. The IRS did issue FAQs. They did not update them for the Consolidated Appropriations Act, but the basic guidance as it relates to what's a partial shutdown, what's our aggregation rules, what are, you know, full-time equivalents, how full-time employees, how do you calculate that, are all addressed in the FAQs and are not going to change for the next update. So these spreadsheets, both this decision-making tree and the next one, will kind of give you a roadmap to work you through the process. There's also in this section, as you see on the bottom left, that kind of just recaps it. So you can have really quick reference material in case you want to go over it, or you think as you work through the process to make sure you cover all the bases. So with that, and this is the 2021, the guidance, the IRS guidance is under FAQs. Here's a link to it. As I said, they did not update it, and I can show you really quickly. There's eligible employers. This is how they defined it. And at the very bottom, it says the last sentence, employers that obtain the Paycheck Protection Plan loan are not eligible. As I stated earlier, this has changed. And so there are some things that maybe have not been updated that as you work through and you look at the frequently asked questions, you probably need to get in touch with your advisor to kind of help make sure that nothing changed. We are waiting on additional guidance. We are anticipating that the IRS will update the FAQs. SBA has done a real fabulous job of keeping on top. IRS, not as good, but hopefully they'll address these in the FAQs, get them updated so y'all will have better references. So, like I said, the first consideration we have to take in is eligibility. You know, and basically it breaks it down to two things. Either you're fully or partially shut down due to the government order during a calendar quarter, or you have a significant decline in gross receipts when compared to the same quarter in 2019. 2019 will always be the base year you kind of have to go back to. So either in the 2020 or the 2021 employee retention credits, you will always circle back to 2019. Also, as we look on this, as you can tell, employer's business is fully or partially shut down, does lean to some subjectiveness. So, you know, we kind of have to look at, while the employer decline of gross receipts is really an accountant's dream, it's a numbers thing, you just crunch it, you get it, and you can move on. When we talk about business shutdowns for government, you got to remember back in 2020, and we don't like to revisit 2020, but back in 2020, at the second quarter of 2020 was when a lot of these government shutdowns came place. You know, you had stay at home declarations. And then it kind of went back to normal a little bit towards the third quarter. And then in the fourth quarter, we had a resurgence of COVID and some additional restrictions were issued by the government. And so you're going to kind of look at the second, fourth quarter for government shutdown, you know, are you essential business? Are you non-essential business? And so all those things play into those decisions of if you qualify under a full or partial shutdown. Well, like I said, the decline of gross receipts is a little bit easier to get to. You're looking at numbers, an accountant's dream. So the FAQs, and we're going to go through this throughout this. I kind of lined them up. So as you look at eligibility, these are the Q&As that address eligibility, or as defined as eligibility. The first one they talk about is orders from appropriate governmental authority. Well, what is that? And so the FAQs kind of really hammer on what is considered an order. And it is, is it a press conference of a media and a declaration of a state of emergency? Well, they said, look, if an official's up there just talking in a press conference, that does not arise to the level of a government authority. However, that being said, what does? The order of a city mayor, closing all non-essentials, state of emergency to shelter in place, local curfews that reduce the amount of hours, those will be considered as a partial shutdown. Q&A 29 really deals with what if you voluntarily suspend? You're nervous, you have older employees, you don't want to expose to it or at risk, and you just shut down your business because look, it's scary times out there. Does this apply? No, not generally, however, if you're closing down your business, guess what's going to happen? You're going to have those gross receipts go down possibly. And so you may qualify and be eligible based off of gross receipts rather than a government shutdown. Questions 30 to 32 deal with partial suspensions, non-essential businesses, essential businesses. So look, as an essential business, you were supposed to maintain your availability to the public. You were servicing customers, well, great. Now I missed out on this. Not exactly. One of the things that are given considerations is if your suppliers had to shut down because they were non-essential. So you were impacted. You weren't able to get the normal stuff that you facilitated in your manufacturing processes and those items. So even those, you kind of have to take a step back and look at, was there a government impact to my operations? So above a nominal amount that caused us to now incur expenses and retain employees that we otherwise would not retain, and maybe you qualify for the ERC credit. Q&A 33, 34, 35, all the way to 38 deals with, if we close, what happens? If you're a telemarketer, so, we work in a firm, we were able to work remotely, we can access our cloud accounting, we can work that away. Were we impacted? Well, if you're able to work some in a telework atmosphere, then you possibly cannot qualify as a partially shut down. If that's the case, you probably, if you would qualify, it might be under the decrease in gross receipts. 34 and 35 deals with the operation of a partial shutdown. These specifically deal with, and they're examples, and all the Q&As there are examples. This one specifically deals with, sit down dining, retail business closes, doctors' offices not available to give non-urgent care services. They would be considered partially. Things like nominal changes where you have a grocery store that had a salad bar and they had to shut down because COVID doesn't allow salad bars. That's not going to qualify, social distancing. So, we all go to the stores and they were letting only so many people go into the store at times. That does not qualify as a partial shutdown. Those, if you're going to have an impact, will hopefully be in gross receipts. Limited customers, definitely social distancing. Those are just guidelines. And because they're guidelines, they don't consider it a shutdown. Questions 36 to 37 deal with related companies operating in multiple jurisdictions. So what they did was they said, well, if you have a store here, you have a store in a neighboring parish or county, how does that impact me? Well, if you close one because of one county or parish, and you said, well, look, it's just simpler, we want to close all. So we can have some company policy that covers everybody. So you shut down both stores. Yes, then you will be able to say, look, we were partially shut down by the government. Even if that store in the other jurisdiction or location was not mandated to close because there was a company policy associated with it, you will probably qualify for partial or full closure due to government order. What happens though when the government order is lifted? So, if you want to use this avenue to pursue eligibility, then what we really need to do is be smart, because when the government's order is lifted, then you're technically not eligible anymore. So it's only that window where the government order is in effect that you have that impact. So that's on the government side. On the other side, though, there's the eligibility related to the decline in gross receipts. So Q&A 39 describes it. What is a decline and what does the calculation look for? And it actually breaks it down in an example. 4043 talks about the definition of gross receipts. Gross receipts basically is sales net of any allowances or returns. Also investment income, sale gain or loss in sale of assets, fixed assets. Those items are going to make up your gross receipts. The relationship due to a decline. Do you have to document if it's related in COVID? Question 41 deals with this. So the economy's down, where I'm at, there's oil and gas. It's been a rough year for us. So you have a decline. Do you have to document it that was COVID, or do I have to document it whether it was an oil and gas issue? The answer is no, you don't. The IRS is not looking for you to document that there's a COVID impact. It just wants you to document that there's a decrease in gross receipts, that you meet that decline. And you're going to have to maintain these records for about 4 years under their guidance. Questions 44 through 45 deals with, what if I started a company in 2019, 2020, am I eligible? The answer is yes. They go through each example of, and if I started in 2019, how I make the calculation. Each one's defined in the FAQs. And so it does give you some reference material to make those decisions. Question 46 deals with gross receipts for tax exempt entities. These amounts are received from, or receipts received from services, investment income, dues, assessments, gifts, grants, donations. It specifically addresses each item. So if you're a tax exempt entity, I highly advise you to look at question 46 to get what your gross receipts looks like for this calculation. So the next step after that is you get yourself eligible through government shutdown or gross receipts decline. What's the next step? Well, the next step is looking if you're a small or large. Under the CARES Act, as I said, in 2020, you're looking if you're 100 or fewer full-time employees during 2019. Under the Appropriations Act, the 2021 quarters, it's an employer that averaged 500 or less full-time employees during 2019. So full-time employees, look, for SBA, a full-time equivalent is totally different than what a full-time employee is defined under the Employee Retention Credit. Employees who average 30 hours per week or 130 hours per month are defined as full-time employees. So this is straight out of the FAQs. How does an employer compute it? An employer that operates a business for the entirety of 2019 calendar determines it by taking the full-time equivalents of each calendar month. Add them all up and you divide it by 12, and that's going to be your full-time employee. And then you can look back and say, do I have 100 or less? Do I have 500 or less? And you can see where you fall into as a small employer. So why is it important to be a small employer? Well, the small employer really impacts what you can use as qualified wages. It's important because if you get in a small employer, the VAT's bigger, the pool of costs are bigger. And so really, if you can get there, that's where you want to get. But before you get there too fast, you have to look again to the aggregation and affiliation rules. And these are defined in questions 25 through 27. The aggregation rules are going to specifically affect, if you had a government shutdown, you have to look at the aggregate, not just individual entities. And you have to look at how those individual entities on those levels impact the aggregate as a whole. It also depends on your full-time equivalent. So if you meet the aggregation rules, you may have to take several entities, look at it all together. And it might push you above 100 plus people, or it might push you over 500 plus. If that's the case, then you're going to end up being a large employer. They're incredibly technical. There's 4 code sections that you have to look at. I'm not the tax guy. That's my buddy Jack there. But there's several tax code sections you have to look at: parent, sub, brother, sister, combined groups, affiliated companies. all those things you have to take into consideration. So if you have those kind of relationships with other entities, it's really good that if you get through the first eligibility question, that you look at these aggregation rules and see how it impacts you as a small or larger employee. So once you get through all this and you decide if you're large or small, how does that impact your qualified wages? Well, it's really simple. Smaller employer, wages paid to anybody during the period, and so it doesn't matter what they were doing, if they were busy working, if they stayed at home, as long as you were paying them wages, guess what? It's going to qualify. If you're a large employer though, wages paid to an employee for the time that the employee is not providing services. So Jim works out on a job site and he's always working there, but then when the job's over with and it's COVID, and I said, look, Jim, I really like you, but you just stay at home. We're going to pay you while you're at home. When Jim's at home, that's when he's going to be qualified. When Jim's out at the job site, not so much, and you're not going to get that qualification. And so by being in a smaller employer, you'll get to say just any wages, and you don't have to look at what the employee was doing as much as, in a large employer, you have to see that providing services. And these are defined in the FAQs. You can see 48 through 61 and 62 through 71. Also deals with health benefits. So not only can you look at wages, and that's the compensation side, but both for large and small employees, you can look at the health benefits that were offered to employees, and those may qualify at qualified wages. As I said, the FAQs give really good guidance and really good examples on what can and cannot be included in these calculations. The difference between the PPP loan limits as it relates to qualified wages and FFCRA credits as it relates to qualified wages, you can't double dip wages, and so if you're using these costs for other credits, whether it's the Family First Coronavirus Act or whether it was for the PPP loan, you have to carve those out as it relates to the employee retention credit. You can't use the same wages twice. And therefore, the limits, you have specific limits as it relates to SBA at $100,000. And so you had to cap that. So if your employees went above that, so in a 24-week period, that was roughly $45,000. There might be some wages out there that got limited that now you can go back and get the employee retention credit. It's on a case-by-case basis. So, these are conversations, like I said, that I really think you have to reach out to your advisors and walk through the process. So that all being said, what you should be doing. So, Jack bombarded you with a lot with the PPP loan. Here I am telling you all of the stuff as it relates to employee retention credit. So now you go get all this information and the decision is what's next? Well, for 2020, if you have a PPP loan and you meet the eligibility, then what you should be looking for. If you apply for forgiveness, so you already went through the application, we are advising you not to go and try to reapply for forgiveness. But what you should do is review your costs for forgiveness. Now, there is some guidance. So we had filled out some applications and say you had payroll costs and you had $600,000 worth of payroll costs on your application. However, you only needed $300,000. So you had this excess cost. What happens to that? There is no guidance. We're waiting on guidance to say what happens to those costs that weren't used, that were excess. Hopefully in the near future, we get it. But while all this is going on, you got to remember that non-41s can be amended for those quarters in 2020. So you do have 3 years to amend your non-41s. So hopefully in the process of the SBA, IRS going through all the ins and outs as things are presented, that we'll get the guidance that we can relate it to y'all, and then we can make those decisions and amend non-41s for those quarters. If you did not apply for forgiveness, so the 24 weeks has ended, you're now in your 10 months, you have some time, you haven't applied yet, look, it is critical. Let's go back now and look at those 40% non-payroll costs. Let's see if we can get those buckets kind of full and reduce some of those wages that are 60% that is needed. You have to hit the 60%, but if you hit 60%, those other wages can be used now, maybe possibly to go get employee retention credit. And if you find that you are, so look, it's now 2021, what we're going to do, you have to just amend your 2020 quarters that the ERC are applicable for and go get your credits. It does take time for the 941s to get processed. The refund process is a little bit slower. So, you have to bear with the IRS, but at least you can go out there and get those credits. As it relates to now, so, we talked about the Consolidated Appropriations Act. Well, that deals with 2021. And so we haven't even gotten through the first quarter. That should be wrapping up soon. Go ahead and start looking at where you are with wages. Also go obtain your second round PPP loan. The deadline is approaching, it's the end of March, and then separately track your payroll and non-payroll costs. There are two options. You can file your 941 for the first quarter, even if you know you're eligible for wages, and we can always amend it. You can file your 941 and not pay and defer your payments in the anticipation you're going to get an employee retention credit. And if your employee retention credit is less, then you need to make up the difference. So there are a couple of options as it relates to that. Also, as it relates to the PPP loan, you have 24 weeks. So you can be smart with what qualifies for PPP loan and what wages we're going to qualify for employee retention credit. So, it's looking at all the facts. So that's why I say you really need to track your payroll and non-payroll expenses. So when it comes time to do the application for the second round of forgiveness or your first draw of forgiveness, that we can look at all the facts and determine where is the best strategy to apply those wages. And so with that, that's really all I have for the 2020. I'll kind of turn it over to Micah. These are our emails. That's mine and Jack's. We'll gladly listen and wait for any questions. Turn it over to you, Mike.
Thank you, Stephen. Thank you, Jack. We have a few questions. We'll just handle them in order. One of them is more of a housekeeping kind of issue. We'll deal with that. So the first one is for Stephen. Well, actually, all three are really for Stephen. The first one is regarding the employee retention credit. The 100 employee count is for what period? Is it between March and December 2020 or a point of time?
So as it relates to the employee retention credit full-time equivalent, there's a specific FAQ that addresses it. And so what you're looking at is at 2019, you're looking at the full year. And so if you have a short year, they address if you have a short year. So if you weren't open all of 2019, otherwise you're looking at every calendar month in 2019, you're adding them up and you're dividing it by 12.
Okay. Are full-time seasonal employees in construction included in count towards these numbers of employees? These employees are hired on a payroll for the period of project only.
So as it relates to seasonal, and this is both for SBA and for the ERC, there are special rules related to seasonal employees. And the FAQs, I keep on referring back to it because they address those samples of what happens if you have a seasonal employee. For the construction client, I think your full-time equivalent does change, but I don't have the calculation available. As I said, it's in the FAQs.
The next question is, will we get a copy of the slide deck? If you want a copy, feel free to reach out. I'm sure we can accommodate you. And the last question, Stephen, I think you kind of answered on in one of your slides. What is the procedure for claiming the 2020 ERC credits now? We got PPP, so we didn't file for them in 2020, but now it appears we can.
So really good question. They issued just some guidance on it. The 941s, you're going to amend for those quarters where you think you qualify for the employee retention credit. And so what you'll do is you'll have to file those 941s. You're going to have to wait for the IRS to process them. And then they're going to submit you the credit that way. It's a refundable credit, so it will be refunded to you.
Okay. And then the final question is, will this recording be available to view again? If so, how? We hope to be sending this out to registered attendees within the next 2 to 3 days. And with that, boy, we got a couple more coming. Now they'll start to roll in. Again, can we have the video? That's going to be the next 2 to 3 days. And then the final question, if we have payroll provider like NetChecks, would we file that amendment through NetChecks or through LaPorte?
I would think I would contact your payroll provider first. for the, if they're eligible to do it, then let them do it. If not, LaPorte can handle it. We would need your non-41s from the previous quarter. We probably need some documentation showing how y'all calculated the credits, and then we can assist in the non-41 amendments.
All right. Well, again, thank you, Stephen. Thank you, Jack. And again, this presentation will be sent out to the registered attendees within the next 2 to 3 days. If you'd like a copy of the slides, let us know. And like I said, we'll accommodate you. And we thank you all for attending. And hopefully we cleared up some of the muddied waters that relate to this COVID relief. Thank you all again.